Did you see the stock market spike the last 20 minutes of trading on Friday? Do you think that was a blip? Do you think it will continue Monday morning? I have no idea, but that's why we have Dan Bird here. He's going to look behind the covers, look under it, and see what's coming our way. Also, talk about the jobs number on Friday. It is going to be an important one. Mr. Dan Bird, thank you for being here.
You bet. How are you?
I'm doing well, man. I got to tell you that close on Friday caught me off guard. I checked in the morning, kind of a ho hum day, and then Olivia says when I get home, the market's up 500 points. What happened? I'm like, oh, it's not. Yes, it was. What the heck happened?
Yep, up 500 points. It was interesting because VectorVest, and I mentioned it last week when I sent a note out to everybody, to my subscribers anyway, that it looked like VectorVest was going to give a confirmed down signal on Friday.
Mhm.
Just needed one more down day. And it had a confirmed down signal all day until the last 30 minutes.
Mm.
And then everything flipped.
That's not normal, right?
Well, it's normal for a Friday and for the last day of the month.
Oh, okay.
You see those kind of things. Yeah. It's
Oh, was this
basically,
just window dressing and people taking
yeah,
profits? Is that what
that's what
happened?
I think. But not taking profits.
Uh,
They were buying to make their books look good. And say, oh
got it.
yeah, I'm in Nvidia. Oh yeah, I'm in
Ah,
this. Yeah, yeah, I'm in there. I'm in the market. Sure.
yeah, yeah. Here's my books.
Right.
Got it.
I
But
think that
that's
was
some window dressing.
I think that was it more than anything else. But let me show you some things.
So as you bring up your screen, start sharing. Is it fair to say that if that's true, it will not carry forward Monday?
That's the question. Yes, that is exactly the big question. So let's take a look. Hang on one second. And look at the S&P. Let me share my
Okay.
screen here.
Yep.
All right, can you see that?
I can. Yep.
So there's the S&P. See that big bar right there? I'll give you a
Yeah.
different view that'll make it really apparent. Look at that.
Wow.
Came up that if it had stayed where where it declined to, that would be a big long red candle, just like this one over here.
Mhm.
Went right to the 50-day moving average, almost to the tick. In fact, the 50-day was at 51. Let me make this a little bit bigger. 51.81, and the low was 51.91.
Okay.
So it went down and just about touched the 50-day moving average, and then suddenly reversed and went back up.
Hmm.
Now, and look at the volume down here.
Yeah, that's what caught my attention first was the volume.
Right.
Also, it's I mean, we talked about last week. Go ahead and look at his playlist. Playlist is Dan Bird. The breadth is not getting wider. It's still getting narrower, if that's even possible.
Yeah, we'll talk about breadth in a minute.
Okay.
But you're right. I mean, it's not going to get wider on a 30-minute rally.
No, of course not. Yeah.
So yes, that still is a concern, and there's actually other concerns as well. So the question then is, will it continue into next week? So
Okay.
first, anytime I see something like this, what I want to see is what is it? What did it actually look like during the day?
Hmm.
So let's look at a 10-minute chart.
Ooh.
Here's a 10-minute chart,
Wow. It really was the last 20
and this
minutes.
is 5 days, and this is the whole week.
Yeah.
So these last two big green ones are 10 minutes each, basically the
Hmm.
last 20 minutes.
Yeah.
This blue line across here is the open. Actually, it's the close from the previous day.
Right.
All right, that blue line is the close from the previous day. It actually gapped up at the open and then sold off, went all the way down, and this is where VectorVest had a confirmed down signal all the way
Hmm.
to till actually probably till about 2 o'clock or so,
Okay.
or 3 o'clock. And then it started at 12:30, it started gaining, started going up, and on reasonable, pretty much average volume. And then the last 40 minutes, 30 to 40 minutes, the volume just started to creep up. this one 10-minute bar, it just started going nuts. And then the last one, it just exploded. So that all of that volume is in the last 10 minutes.
That's wild.
Yeah. So that's traders. It's the end of the month, end of the week. Traders positioning themselves, make their books look good. It wasn't an end of quarter. You see this a lot of times. You definitely see it a lot of times on options expiration day. And also at the end of a quarter when they want their books for the quarter to look good. But sometimes you see it at the end of the month, but especially when the end of the month is also a Friday.
Got it. Okay.
So that's what I think happened. So now, will it continue? That's the big question. First of all, so I drew this resistance line right here. You can see this is major resistance going back to Wednesday. This is Wednesday when the market was selling off. It kind of went sideways. This is the S&P. Kind of went sideways for Monday and Tuesday. Went down a little bit at the end on Tuesday. And then Wednesday it opened, gap down, and then tried to make a recovery. Just went sideways until the very end. Again, look at these are 10-minute bars. So look at the last 10 minutes here. Look at the last 10 minutes here. So, that often happens right at the end of the day, not that kind of 10 minutes. You can see the volume too. I mean, the volume is all the way across. So that type of thing happens at the end of a day a lot of times. Sometimes it's options, people in options, they could have daily options, 0 day to expiration, things like that. There's lots of reasons that it happens right at the end of the day, but the one on Friday was much bigger. And I think that's because that last day of the month. Now let's take a look at breadth, just as you mentioned. So so remember, this blue line is the previous day's close.
Okay.
Technology represents, this is the technology sector, XLK. Technology represents about 40% of the S&P. Okay. So you would expect that if we're getting this kind of rally at the end of the day, blowing through the previous day's close, that we should see that kind of rally in technology too. Right?
Yep.
But it never even got back to the previous day's close.
Interesting.
Right?
Okay. Yep.
Discretionary, which is the consumer, or one part of the consumer. It's the part where people will spend when they just want something.
Right.
All right. Same thing. It didn't make it back to the previous day's close either. After being down most of the week until Thursday, it made a little bit of a rally, but discretionary didn't come back. Communication services did.
Interesting.
Get over the line. This is the internet companies. Financials did. Industrials did. And these are primarily the aggressive sectors, right? So the key one is technology, because that's 40% of the S&P. And that is the number one aggressive sector.
Yeah, and we saw a lot of technology companies, specifically enterprise software space you and I know well.
Oh, yeah.
Really weak, like Salesforce, UiPath, and others. Pretty weak.
MongoDB.
Yeah, MongoDB.
They didn't do well either. We've got CrowdStrike coming next week.
Yeah, Monday, I think. Yep.
By the way, my nephew works for CrowdStrike. And a guy I used to work with at Mercury is the VP of sales over there.
Somebody I know?
Jim Seidel.
Oh, yeah. Okay. Yep.
He was on the East Coast in the office where I work.
Nope. Okay.
So my nephew mentioned that they have made a decision to stop, and I'm not sure exactly if it's to stop paying accelerated commissions or just stop paying commissions.
Oh,
this is just a couple of weeks ago, and I don't think that's.
And again, it could be hearsay.
Could be hearsay. Yes, it could be hearsay.
Yeah, don't make any investing advice off this.
That's right. This is not. I'm not recommending anything.
No.
So it could be hearsay. We don't know. This is just one guy.
Well, let's play with that. You and I were in commission sales. Let's just pretend company A we're not going to name anybody's names. They come down with an executive decision that they're not going to pay commissions.
Mm-hmm.
Commissions for 90 days or 120 days. What would be a couple of things you would think about? You and I were both quota carrying salespeople. What would
Yeah.
be one of the first things you would think of when your boss delivered that message?
Where can I go next?
Oh, instantly, right?
Yeah. Now it could be just one group of sales. So it could be the inside salespeople. It could be something like that. We don't know the details.
Oh yeah.
But yes, I mean that's the first thing I would think. The second thing I would think is, well, how are they going to make up for that? Are they going to raise my base
right
to cover it? And they may. That might be the way they do it.
Yeah, you know what I think? The first thing I think of is an account, and again, my brain always goes back to accounting. Is oh shit, cash management. This is not good.
As a stock investor, that's the first thing I thought.
Oh, you thought that too. I was like, ooh.
Yeah. So as an investor, yes. As a trader, yes. I'm thinking, okay, earnings are next week. They come out with this 2 weeks before earnings.
Yeah, and the reason
after the quiet period, by the way.
Yeah, exactly.
So if they're going to let the market know about something like this, they would do it on the earnings call.
Yeah,
right?
Monday.
Right.
Yeah, because guys, if you don't know why this is important for cash management, if you don't know how commissions work, generally speaking, you book a deal, you take revenue, but revenue might be over a year. You're going to pay commissions when revenue is recognized, but you may not get the cash for 30, 60, 90 days. Revenue recognition, commission payments, it has nothing to do with cash collected. I'm going to make sure this is correct. I think there was only one comp plan I ever had where collections was part of one of the variables, and that was when I was an executive.
Yeah, normally you see that in hardware sales because the margins are much thinner.
Right, thinner.
You don't see that in enterprise software.
No. So
where they have 70 and 80% margins.
Yeah, they're not too worried about it. Yeah.
Yeah.
So that's interesting.
Yeah. So that conference call is going to be very interesting. We're going to take a look at the CrowdStrike chart, which is also, I think, is very telling.
Could you look at Salesforce too? I mean, I don't know if you had that
let me finish this narrative first.
Please.
So these are the aggressive sectors. Let's look at the defensive sectors the same way. Staples. Not only did Staples exceed the previous day as the market was falling,
exactly,
which you would expect if people are rotating into defensive sectors, but it stayed up there even as the market was rising. So it actually contributed to some of this rise.
For sure.
Utilities, same thing. Healthcare, same thing. Energy, materials.
So is this so? Are you telling me that people got out of tech into other stuff? Is that what happened?
Yes, they got out of tech into other stuff. In fact, they got into other stuff more than they even got into the other things that weren't tech. So communication services, these are the internet companies. This is the Google and Meta. Right?
Yeah.
So remember what these charts look like. Defensive, they took off right from the beginning and stayed up there.
Yeah, right? Utilities from the jump. Healthcare from the jump.
Utilities right at the beginning.
Energy.
Healthcare right at the beginning.
Wow.
And if we look at communication services, it just kind of wandered along, sort of going along with the market as the market was falling, and didn't start going up until the market started rising.
So let me ask you this. So when I look at this, and again, I'm wrong all the time, so tell me, looks like breadth is actually getting better.
Well, first of all, remember technology is 40% of the S&P.
Sure.
All right. I don't know how much discretionary. I meant to look that up on each one of these and put the numbers in, but I don't know how much discretionary is, but it's a pretty good one too, and it's the consumer.
Mm-hmm.
So they were both negative. So yes, if you look at the defensive sectors, yes, they did better. So this could be rotation. So if technology is 40%, then that money is rotating into these. So yes, it could mean it's getting broader, but let me look at another measure of breadth, which is, I put this in my newsletter and I'll show everybody that in a second. So high-low charts. So this is one way to measure breadth. And this is actually when you see articles and people talking about the breadth is getting worse and it's declining as the market goes higher. Breadth is getting weaker. This typically is what they mean. So if we look at this third panel down here, this is the S&P again, large cap, new highs versus new lows. So the market is hitting new highs up here, but there are fewer and fewer companies making new highs.
Okay.
Right?
Yep.
And this is new highs minus new lows down here. It actually went negative a little bit right there. But again, if we go back to this high where we made a high back here and then we retraced, so you would expect this to retrace. But if we come back and we make a higher high over here, you would expect that to be made with higher new highs. Right?
Yep.
Both on this one and this one. But it didn't. That's breadth. And down here is the bullish versus bearish sentiment. So even though we're making new highs up here, the sentiment is still going down. So that again is a warning sign that will this last till next week? Well, let's look at something else I have here. This is there you go. Can you see that?
Can.
Okay. That's from Investors Business Daily. This is the June performance going back to 1950 for election years. And here's where we are. So here's next week for election year.
Okay.
Everything's going higher. So I suspect that rally could carry over at least at the beginning of next week until we get to the jobs number. And then, of course, the all-important one that we've been talking about, and maybe next week, unless you're not going to do, unless you have something else going on.
No, we'll be here.
Okay, so next week we'll talk about CPI.
Yeah.
But CPI at 8:30 and the Fed rate announcement at 2 o'clock, same day.
I like it. Okay.
So this right here implies to me that we might continue that rally into next week, but we shall see. One other thing I want to show you, and this was a email that I got from a subscriber, and they sent me an article and said, hey, what do you think about this article? It's a thing called the Hindenburg Omen.
Yes.
Have you heard about that?
Oh yeah, I've heard of it. Yeah.
All right. So here's the historic. This is my website, just for people that want the newsletter. Just go to breakpointtrading.net, and you can click on this button right here, and you can get the free newsletter. And if you want to register and get alerted that the newsletter is available on the home page, at the very bottom, just sign up for the $0 one, and you'll get a reminder that the newsletter is available. But anyway, he sent me a note, and actually this down here, this historical chart, this is the chart that he sent. Hindenburg Omen and Titanic syndrome. Right, so it shows 2007, 99, 89. This is the sum of both of these.
Right.
And I'll talk about what the criteria is for these in a second. And then this is the latest peaks: 2019 before COVID, 2024. Now, 2018, we had a sell-off. We had a little sell-off in 2015, actually just before the election, 2016. Had a much bigger one in 2018 with the trade war.
Yep.
So these were, they were off by, as much as 12 months, perhaps. So you can't read too much into the timing of this necessarily. Right. But and for me, it's just interesting. There's actually something about this that when I put this together, I thought was even more interesting. But it turns out, when he sent me that note, turns out that I had read about the Hindenburg Omen years ago, probably 3 or 4 years ago. And I actually created a chart for the Hindenburg Omen way back then. And I had completely forgotten about it until he sent me that note. And so I put that on the website now, if anybody's interested. But the first thing I want to do is, and this is in this article, this explains the Hindenburg Omen, what it means. The most important thing is, since the omen's rate of success is estimated at only 25%, traders would have jumped unnecessarily a number of times. Traders might use the indicator in conjunction with other forms of technical analysis to provide confirmation of sell or take profit signals. So really important to understand that this only has a 25% success rate. Okay.
Yeah, that's the case. We're not obvious. That's not great.
No, it's not great at all, but it's interesting.
Oh,
so
sure.
here's a six year. This is the chart that I created. This is the Hindenburg Omen.
Okay.
That's a 6-year view. Anytime it's above this pink line, the blue one is the Hindenburg and the red ones are the Titanic.
Oh, got it. Okay.
And I think on the longer term, oh, this is the 6-year chart. Yeah. Let me look at the 18-month because this is closer in. So here's the 18-month chart. So the way to kind of read this, and this is the criteria for Hindenburg, the NASDAQ 100, so big cap NASDAQ, has to be over their 50-day moving average. That's this red line down here. So number one, it has to be over that line. Number two, NASDAQ new highs and new lows. Remember the chart we just looked at for breadth that I showed you? New highs versus new lows. Both of them have to be more than 2.8%. Now, this number varies. I'm probably going to change this to 2.5 down here because the article I provided says 2.2, but the one that the subscriber sends says 2.8. So I'm going to make this 2.5, just split the difference.
There you go. That makes sense.
But the important thing about this is that the new highs and the new lows have to be above and below this line down here. That doesn't happen very often, right? You get new highs, but then the new lows will go up. I mean, become less. Or you'll get a bunch of new lows, just like this right in here is a good example. You'll get new lows, and then the highs will come down. You very rarely get new lows and new highs at the same time. All right, so both of those have to be satisfied. And then number three is the McClellan oscillator, which is basically a moving average of advance and decline lines. I showed that on here many times before. So it's just a moving average of the advance decline lines. It has to be below zero. So anytime down here where you see this in the red, that's below zero. So all three of these have to be satisfied together. Not just one of them, all three of them have to be satisfied. And when that happens, then these spikes above the pink line is what that's indicating. All right. So this year, the first part of this year, a lot of those were satisfied. You can see all the spikes up here. If we go back to the last time that happened, there's really only one spike for Hindenburg, but the Titanics were up quite a bit. Now the Titanic criteria is the NASDAQ 100 making new highs and a sudden jump in new lows versus new highs. It's a little different. Actually a little bit easier to satisfy, frankly. All right, so that's the red ones up here. So this is the last time it happened right here. It was in June, July, August timeframe of 23. And that's, if you remember, well, actually we can look at it right down here. So here's the downtrend we had last year through the summer that didn't hit bottom until October.
Got it.
All right, so that line right there, so you can kind of follow this happens, and then the result happens.
Got it.
It's not immediate, takes a while, and then the result happens. So right now, it's doing all of this right now, and we did have a pullback in April. Actually, this is, April. We did have a pullback in April, so this might have been a good indication of that April pullback. But I don't think that means, I think the Hindenburg, for me, and nothing actually says this, but for me, the Hindenburg actually expires basically when you get these big gaps down.
Right.
So when
Makes
you have a
sense.
gap, that means none of those are being satisfied. Okay.
It's like a reset. Yeah,
And
I get
that's
it.
the thing that was the most interesting to me when I looked at this chart. I looked at the gaps and I said, oh, well, it looks like these gaps are just before a big rally.
Hmm.
All right. So we've got a couple of gaps right here when we had this April sell off. And now we're getting a rally. Now we're just starting to get the Hindenburg things again.
Got it.
So does that mean we might be rolling over again? I don't
Hmm.
know. But it's interesting. But I think the gaps are more interesting. I think,
Yeah.
you know, when we have a big downtrend, these are the things to watch to say we're getting close to a rally,
Oh, I like that. Okay, that makes sense.
right? So that's the Hindenburg Omen
Very cool.
for anyone that's interested.
Well,
So,
let's look at a couple of quick stocks before we get
oh yeah,
into video
yeah,
number
yeah, yeah.
two.
Okay, sure. Let's first look at CrowdStrike.
Sure. Let's do CrowdStrike and Salesforce, and then we'll move on.
Right, look
Okay.
at that.
Yeah, that's pretty ugly.
CrowdStrike. So they haven't reported yet. They report on the 4th,
Yeah,
actually
Monday.
after the
Oh,
close. No, that's Tuesday.
Tuesday. Sorry. Yeah, Tuesday. Sorry.
After the close on Tuesday. So huge volume, big down days, and more importantly, if I go back, I think it's on this chart. What I look at is how is CrowdStrike doing versus its peers?
Mm.
Well, they're actually outperforming their peers because it's above the zero line down here.
Yep.
But recently, in just the last couple of weeks, basically, they've actually just last week, and really probably because of this,
Couple of days. Yeah.
yeah, just a few days, they've started to underperform their peers. So that's not a good look. The charts, you know, all the lines have crossed, the momentum lines have already crossed
Yeah,
to
that's
the
ugly.
downside. So, and huge down days on big volume.
Yeah,
So that means somebody knows something ahead of the earnings.
yeah, I would think so.
Right? Right? So
Yeah.
I would
Who
be
knows?
very reluctant to get in. Now, what they might know is what I just said. Will they be announcing that they're not paying commissions anymore?
Again, we don't know that for a fact, folks. It's
We
hearsay.
don't know. We don't
Don't.
know.
Yeah, we're not. It's crazy.
But this is not one I'd be jumping in before earnings.
No.
So
No.
Salesforce,
Yeah, SFDC or CRM. Oh, there you go.
CRM, their Salesforce, big gap down, huge volume. But this is after earnings.
Yeah, it's after earnings. Yeah.
Right. So here was support right here, and before the earnings, and the earnings came on this white candle day, but their support. So, you know, traders were just, you know, hoping earnings would be better.
Yeah.
They didn't break support. But for me, what I would be looking at in this, first of all, we'll look at how they're doing versus their peers. And they have been underperforming. So now it's below the zero line.
Yeah.
So here's the zero line here. So they've been underperforming since way back here in April.
Mm-hmm.
And then that started to accelerate before the earnings. So this was giving warning signs way back in April that they were going to miss earnings.
Yeah. Okay.
And then earnings came out and big, huge drop.
Yeah, look at that. Wow.
So I was talking to someone about, you know, setting stops and how to set stops and that type of thing. And she didn't quite understand it. And so I brought up the CRM chart. I said, so look, you can see where there was big support on the left-hand side over here. I mean, the resistance over here, which then when it broke through, it became support, and it became significant support over here. So she's like, oh, that's where I should put my stop. I said, well, you should actually put it a little below that.
Right. Because
it could come down a little bit and go back up. So that's at 268. So maybe put it at 260 or 265.
Yeah.
I said, but so she goes, oh, so when that big thing happened on earnings, I would have been out at 265.
Nope.
I said, no, you wouldn't be. Because what happens with a stop is as soon as it passes the price, it turns into a market order.
Right.
And a market order executes at whatever the price is at the market when it opens.
Yeah.
And in this case, it opened way down here at 220. So a stop in something like this will not help you.
No.
That's why I don't like holding through earnings as a trader. As an investor, you're holding for the long term. It doesn't matter as much.
Right.
You should always, keep track of earnings on the companies that you're holding.
Right.
But a stop would not help you in a situation like this.
No, it would not have helped.
And then
No.
the next day, you've got this big white candle. That's all short covering.
Mm. Got it.
Shorts covering their shorts means they have to buy. So the question is, will this continue or won't it?
Yeah.
I
Very,
think
very cool.
I think the CrowdStrike earnings on Tuesday is going to have a big effect, especially on enterprise software.
Oh, I think
So
enterprise software is in the doghouse until otherwise noticed.
here's MongoDB. Oh, by the
Oh,
way,
yeah.
on one more thing on CRM. So when this dropped through the 50-day moving average right here,
Yep.
it went down here, and people might have thought, well, looks like it's bottoming. Looks like it's a good company. Maybe I should buy it here. But because it couldn't get back through the 50-day moving average, that was telling me that they're going to miss earnings, among all the other things on the chart.
Yeah.
They couldn't get back through the 50-day right there, right? So MongoDB, same kind of thing. They actually couldn't get back through the 200-day right there.
Yeah.
So big, huge. There's another gap down, but it was selling off even before earnings. And there's how they were performing versus their peers. There's the zero line. So all the way back here in March, they were underperforming their peers. What else? It seems like there was another one last week.
UiPath was the other one.
Oh yeah, that's Path.
Not sure.
Yeah.
Yep.
Yeah. There's another big gap down. Also, there's the zero line right there. They've been underperforming their peers since way back in February. And started selling off. It couldn't get through both the 200 and the 50, couldn't get back through it right there. I mean, all of this would be telling me they're going to miss earnings, which they did.
Yeah. Right
there. So yeah, enterprise software in general is not doing well. Now,
no bueno.
Now I'm starting to do a short squeeze alert to subscribers, annual subscribers.
Yep.
So I have a list of short squeeze companies that have more than 20% of their float short. So what that means, the float is the total number of outstanding shares that people can buy. 20% of that means that 20% of their outstanding shares is borrowed for shorts to short it, hoping they can pay it back when it goes down and give back the borrowed shares. So 20% of shares borrowed is pretty high. So this is a list of anything above 20%. The highest one on there is like 80% short. But whenever it hits certain criteria, like volume has to be high, it has to be above the last 5 days, a number of things that I'm looking at, then it creates an alert. And I send that out to people, and I recommend that you don't do anything with it unless you're a really good, not professional, but experienced trader. But it's fun to watch to see what happens with it. So the one that everyone knows is GME, of course.
Yep.
Right? That's GameStop. So you see this white candle right here? That's where my alert would have triggered.
Oh, wow.
And if I wanted to play the short squeeze, I would put a stop above that price somewhere up here, meaning if it goes through it, it's going to execute. And of course, right here, it did execute. And what I would do with short squeezes is put a 5% trailing stop on it, because you never know when it's going to come back down.
Right.
So in this particular case, it probably would have executed on this red day. And the next day it would have gone up, and I would have been taken out with my 5% stop, and I would have made 40% in one day. And the next day it opened at 65. So down here it was trading at about 12. In about a week, it was at 65.
It opened. Damn.
Opened at 65 and sold off the whole day.
Yeah.
Right. So that's what a short squeeze looks like. So the reason I'm showing you this is that one of the ones that appeared and that I actually did buy and it's an enterprise software company, is AI.
Hmm.
C3 AI, company started by Tom Siebel.
Mm-hmm.
All right. So it gave the alert right here on this big long white one. So I actually bought it. I've got a stop right at the 200-day moving average. And it's the short squeeze hasn't really executed yet.
Hmm.
Because as I think I've mentioned before in the past, for a short squeeze to really take off, it needs to get above where shorts are feeling pain.
Right.
And that's probably at this area right here, around 32. So right now it's at 29.57. If it gets up to around 32 and it goes above it, then all of these shorts back here are going to start covering.
Mm.
And if
Very
it gets
cool.
to 30, if it gets to 37, these shorts are going to start covering. Right. So it has the potential of being a huge short squeeze like that. So I'm just going to watch it and see what happens. But,
Cool.
you know, it's in the AI space. It is enterprise software, which is taking a beating, but AI is not. So we'll see.
Very, very cool, folks. Well, we're going to talk about inflation and deflation next. Please show your website one last time.
Sure. For those interested, go to the homepage. Just go to breakpointtrading.net and click on this little box, and you'll get the free newsletter each week. And if you want to be alerted, just go down and click on the $0 one. No credit card. We don't share emails. If you want all of the content that I have, including all the alerts that I send out, it's $99 per year.
There you go. Thank you so much.
All right. Take care.